Hi, this is Bruce at Turnaround Stock Investing. Today we're going to be discussing Starbulk carriers. But before we start, I want to mention that Turnaround Stock Investing is not an investment advisor. This content is for educational purposes. Please see our disclaimer at turnaroundstockinvesting.com. You're now looking at a chart of Starbulk carriers. I believe that over the next 3 years, it's possible that Starbulk could rise 1,000% or become a 10-bagger if various scenarios unfold in the proper sequence. Every investor right now is familiar with the ongoing China crash and the fact that dry bulk rates are hovering at $3,000 a day currently. The gloom is thick. In fact, you're looking at a recent article in the Wall Street Journal titled "Dry Bulk Shipping Firms Face Unprecedented Crisis." In the article, it points to the fact that the industry is operating in an Armageddon position, or an Armageddon level. This is the first time in my long career as a distressed investor that I have heard an industry described as operating in an Armageddon scenario. If an investor is to buy when blood is in the streets, this is the apt time. I believe that currently Starbulk is not suffering from a balance sheet insolvency. It is suffering from a cash flow crisis. In the table in front of you, I have crafted a back-of-the-envelope table for predicting future EBITDA based on 80 ships at various time charter equivalent rates. At $5,000 a day in TCE rates, the company would generate a negative EBITDA of $23 million. After interest and principal payments, the company would have negative cash flow of $182 million. Comparing this to an estimated cash balance in January 2016 of $250 million after the sales of vessels and equity required for new build acquisitions, clearly the company could only survive for 1 year under this scenario, considering that company must also maintain $500,000 of cash for each vessel operating, or $40 million. So it's clear to see why the share price is 40 cents, which is equivalent to a market capitalization of $90 million versus a book value of $1.4 billion. However, with all of this gloom, let's consider the possibility of various scenarios that could occur that investors are giving zero chance to happening. The first scenario is that it's highly likely that dry bulk ship scrapping rates will accelerate quickly and that dry bulk owners may soon begin laying up ships. This is my third cycle investing in the shipping business over the past 30 years, and I have found that shipping has a unique ability to right-size itself in the worst of times. Considering this is the worst of times, I'm assuming that owners will soon and quickly lay up ships and start delivering dry bulk vessels to the scrapyard. If this were to happen, it's highly likely that dry bulk rates for various dry bulk vessels could rise from present prices of $3,000 a day to $7,000 or $8,000 a day. Under that scenario, you're looking at an EBITDA generation of between $30 and $60 million. The second scenario concerns China's domestic coal and iron ore industries that are losing incredible amounts of money. Some suggest billions of dollars in annual operating losses when interest and principal payments are factored in. If China decides to shut down just a portion of these cash-burning coal and iron ore mining companies, even slightly, the demand for imported coal and iron ore combined could move up by 30 to 50 million tons. This would have a large incremental impact on supply and demand for dry bulk vessels. I'm not suggesting this is a high probability, but it is a probability to consider. The third scenario. Oaktree Capital Management, which owns 50% of the equity in Starbulk, I believe has a cost basis of $600 to $700 million for its Starbulk shares that are now presently worth $50 million. At this point, investors are fearful that another round of equity offerings are in store, or worse, a preferred stock offering that Starbulk would offer to Oaktree, which would prime Oaktree over existing shareholders. I view this risk at 25% given the company's recent sale of Cape vessels. The sale of the new building vessels indicates to me that the company is going to burn the furniture, so to speak, or in other words, use the equity inherent in its new builds to stay alive over the next 2 years. As of September 30th, 2015, Starbulk had equity deposits on its new build vessel program of $295 million. I'm estimating that after a 20% discount for the decline in new build values, that the company has an equity value in its new builds of $245 million. The company has started to realize these equity proceeds with the recent announcement of the sale of 5 of its Cape-size vessels. However, the most convincing evidence that Starbulk will try to prevent a significant dilution comes from the CEO Petros Pappas. I believe he is sitting on a capital loss approaching $100 million. He received 8.6 million shares in Starbulk at $12 a share when he swapped his ownership in Ocean Bulk Carriers for Starbulk shares, then worth $100 million. Those shares are currently worth $5 million. I'm sure that this CEO is working day and night to figure out how to recover a portion of that lost fortune. I'm also confident that Oaktree or Starbulk would not offer him equity grants large enough in the future to make up for this significant loss, thus incentivizing him with all of his might to right-size the company and allow it to survive through this shipping depression. It is in his interest. Scenario 4. I believe that after Starbulk takes delivery of its last new builds, the Ultramaxes, this year, it will enter into an agreement with its existing banks to stretch out amortization payments. If you look at the EBITDA table in front of you, you will see that I have proposed a restructured interest payments to the banks of $80 million of annual interest and $40 million in principal payments, as opposed to the $50 million of interest and $110 million of principal payments under the current capitalization structure. Given that Starbulk's balance sheet is strong for a shipping company and solvent under rates of $8,000 to $10,000 a day, I believe it's in the bank's interest to work with the company, as it will protect their collateral value during this downturn. Over the past 3 decades, it has not been uncommon for banks to stretch out principal payments to owners that have reasonable balance sheets when day rates are at depressed levels. In this scenario, if rates were to rise to $10,000 a day under the restructured scenario, the company would be able to generate enough cash to break even after interest and principal payments. If rates were to go above $10,000, the excess free cash flow can be swept to the banks for principal paydown. In addition, the specter of a foreclosure by the banks or another distressed private equity fund buying the bank debt also seems very unlikely. The reasons being that distressed investing hedge funds have been crushed investing in the dry bulk industry over the past 2 years. Funds that bought the bank debt of Genco and Eagle Bulk and a few other shippers have lost billions of dollars as the shares they received from the debt to equity recapitalizations has plunged. Right now you're looking at the emergence of Genco from bankruptcy. The shareholders were given shares at $21 a share that are now trading at $1. This puts Starbulk, in my opinion, in a better negotiating position with the banks, as few distressed investors exist to buy Starbulk's bank debt at the prices the banks would want. In addition, distressed investors don't like to buy companies that have negative EBITDA. This scenario raises the odds that Starbulk can negotiate a principal reduction plan. While it's impossible to know what's going on in the minds of the banks, I think that it's likely that some sort of agreement can be reached without Starbulk having to raise more equity in 2016 thanks to the sale of its new build vessels. Of course, this is a moving target as the future is unpredictable. However, if scrapping and layups occur over the next 3 to 6 months, rates may move from their current levels to $7,000 or $8,000 or even $10,000 a day. I believe that Starbulk's cash balance after the sale of vessels and equity required for new builds in late February will be around $240 million. With this cash balance, if rates were $8,000 a day, thanks to scrapping and ship layups, under my restructured interest and principal payment scenario, the company would have to come out of pocket by $60 million for principal and interest payments from its existing cash balance, which is quite doable. At its current price of 44 cents a share, the company's market equity capitalization is $90 million against a book value of $1.4 billion, or $6.60 a share. No doubt, given the declining vessel values at the present moment, the net asset value in the marketplace is probably $1 to $2 a share, with that far from possible to be realized due to the current rate environment. However, let's assume a rosier scenario. Assume that over the next 3 to 4 years, dry bulk vessel rates were to climb to $15,000 a day. In this scenario, Starbulk would generate $254 million in EBITDA. That is $1.20 a share in EBITDA based on 220 million shares outstanding, assuming no dilution between now and that date. If this were to occur, no doubt the stock would trade for at least $4 to $5 a share. To date, we have seen the devastating effect that declining dry bulk rates can have on a leveraged balance sheet of a shipping company. The markets are assuming that between now and 2018, Starbulk will have to issue a lot of equity capital and that dry bulk rates will likely not rise. I believe it's time to consider the possibility that equity capital may not have to be raised in this vicious downturn, thanks to the factors I mentioned above. As the saying goes, the best antidote for low prices is low prices. Of course, if rates do not rise and stay at current levels over the next 2 years, it's clear that Starbulk will be at the mercy of the banks and a large dilution very probable as Oaktree steps in to save its investment. Let's assume an equity offering of 500 million shares at 30 cents for $150 million. That would leave 725 million shares outstanding for Starbulk. Now let's assume another 100 million shares are given to extend amortization to the banks, bringing the total number to 875 or 825 million shares outstanding. As incredible as it sounds, despite this massive dilution, if rates were to rise to $15,000 a day, the company would still be able to earn $254 million in EBITDA. Of course, its shares outstanding would rise to 825 million shares, but that would be equivalent to 30 cents a share in EBITDA. I believe at that level, the stock would trade at $1.50 to $2 a share, depending on the animal spirits of investors at the time this occurs. You have to realize the shares are trading right now at 40 cents a share. So I have presented 4 scenarios for an optimistic upside. An investor looking for a possible 10-bagger has to assign his own probabilities to the various scenarios. If your scenario is recovery with no dilution, you're looking at a 10-bagger, as the stock could rise from 40 cents to above $4 a share. If your scenario is a China bust with continuing and declining rates for 2 or 3 years, with Oaktree doing multiple rounds of equity infusions, the scenario is not that great. I am betting that the more optimistic scenario of muddle through and recovery has a greater than 50 chance of occurring. No one at the present time can predict with any accuracy what will happen. That is why Starbulk has the possibility of being a 10-bagger. If you're interested in learning about more possible 10-baggers out there, I suggest you become a member of Turnaround Stock Investing.